still on. It's still on. You
Oh,
gotta shut it off.
Please.
They have trouble.
Lynn, if you put your mouse over Harriet's iPad, you could shut her off. You could kick that one out.
Okay. I think you got it, Len.
Of her
Good.
iPad, top right corner.
I think you got it.
I muted her.
Good. Okay, I think we're okay. All right, let's just start again. So we have an unprecedented event here. There's no doubt about it. We can all look at the same facts and maybe come out with different conclusions. The numbers read like this. When you hit the bottom at the beginning of March, you went down about 36%, both on the S&P and the Dow. We've come back about 50% of that. So depending on the day that you're looking at, you're somewhere between 15.5% and 18% off of the top. Now, there's no rule that you own the top, otherwise you owe what is sold at that point, right? So let's just take a look at what this is about. This is about freezing the entire global economy for the most part, especially the United States. You know? Everybody here has a different personal situation depending what you use your investments for, right? So those of you that use your investments for fixed income and for monthly income.
He lives here, Harvey Joseph.
You didn't get Harlan. You're going to have a challenge for the next year or two because interest rates, as you can see, anything that's guaranteed is approaching zero. So that's a challenge right there. So our conversation tonight is really going to differ.
You know, I didn't want my picture.
Why would you?
You got it, Lynn? Yeah.
I think so.
Okay, good. So our conversation is going to differ depending on what you use your investments for. If your investments is just to grow, get leave for your estate, that's one thing. Another is if your investments, if you pull a certain amount of money out monthly, quarterly, whatever, all right? So you don't want to make statements here that just brush everybody by because everybody's got a different goal in mind, all right? I had a conversation with Morley earlier in the week, and he made a statement.
So that's not Morley. I wonder who that is.
It's Michael Bauer.
Yeah, you don't have her muted yet, Len?
I thought I did.
All right, try it again.
Yeah, her iPad is muted. Let me check.
Okay.
I'm sorry.
That's okay. All right, let's try to go now. So I think that Molly made a statement earlier in the week that if you're investing for 2 or 3 years and you can live, then, you know, close the portfolio up and come back and take a look at it in 2 or 3 years. The difference with this and say 08 or 09 or any of the other viruses that came across the world is that this is definitely going to have an effect on what our lifestyle is going forward, all right? Even once we have the vaccine, and at the best, maybe 12 to 18 months until everybody gets it. And then you got to make sure that you think that it works, okay? The nature, I think, how we're going to interact, certainly for the next couple of years, is going to change. So I think there are certain sections of the economy that are going to do pretty well here or hold its own, and there's others that are getting whacked, all right? If you're a deep value investor and you think that the cruise lines or airlines are going to come back, and you could check with Warren Buffett to see how he's doing on that, then you can go ahead and say, boy, at this price, something is going to be okay in that industry. I'm going to buy it at this distressed rate. Yeah? Okay, so that's one way to approach it. The second point I think make is that it's been kind of easy through the second half of this past decade to sort of just follow the averages, what we call passive investing, okay? Passive investing, you get the S&P 500, you buy the Dow, Russell, whichever. I think that's going to be more challenging, and you're going to probably underperform the rest of the markets by doing that. That doesn't mean you have to get rid of it. You may want to take something off the table, or any new money, you may want to think about ticking your spots. So in other words, before you could just throw darts pretty much, and with the market going up with such low interest rates, you're a winner. I don't think that's going to happen in 2021 and maybe even 22, okay? I think you have to be a little more surgical if you're going to try to get ahead on this, all right? I think, Morley, do you want to step up and add to that at all?
Yeah, I would say that, you know, on the one hand, you could really make a very negative case for the economy. Remember, the economy and the stock market, they don't go exactly in lockstep. The stock market will go up before the economy starts to get real improvement. But you can make a very bad case that over the next, who knows how long, things are not going to be good. They're not going to be back to normal. But at some point, like the other case, at some point in the future, things will come back. Maybe not the same way, but in terms of investments in the stocks in the market and companies, you know, these companies will come back. Some won't survive, but many will survive and come back. So if you think the economy is going down the tubes and is never coming back, you don't want to be a stockholder. On the other hand, there's nothing really to do with your money. If you put it into, like Mike says, you put it into bonds, take your money out of the stock market, go into bonds, you're talking about 0.5%, not even that much. So you'll be eating up your principal that way. So, you know, I think if you want to be optimistic, you feel that the stock market and the economy will get better next year and start to come back to more of what it was in the past, maybe in 2022. But in the meantime, if you own stocks, you're collecting dividends. If you sell those stocks, you're not going to get dividends. You're going to get money market rates, which is 0.2%. So, you know, if you look at the whole situation and feel that you're optimistic about this country, then I think stocks are okay to buy here. You know, we're talking about, you know, what we think the market might do, but you know, in terms of the economy coming back, it's got to come back in a U shape. I don't see it coming back in a V shape, but you can see the market go up in a V shape. You go, because at some point in the future, they say we've got a virus and it works. This market will spike up, and you know, if you're out waiting to get back in, you may not get back in at the same price that you got out of.
This market also is going to test your risk tolerance, and you should sit back and say to yourself, how much can you tolerate? How much pain will you be able to tolerate? Because there's a chance that we'll go back again. I mean, I jotted down for this. You're looking at a Dow and an S&P that may drop another 10 or 15% here. Okay, the market may get ahead of itself. So make a decision of how much you're willing to risk at this point. And there might not be any clarity in this until fourth quarter, maybe first quarter of next year. So like Molly says, you know, pick your spots. It's not the worst thing in the world to be a little heavy in cash at this point. If you feel like you can't deal with it, then go to speak to somebody and maybe you've run your own portfolio now. But looking back, it's been kind of easy. You know, like I say, you threw a few darts at the wall and everybody patted themselves on the back. This is going to be really some tough slugging for a while, because when Molly points out about what your yield in bonds are, and you can even do a little better than that if you're willing to take risks, but you better check out what bonds you do own, if you do own bonds, because there is a greater risk today in the whole bond market than there's ever been before. I don't care if you own bond funds or, you know, hopefully if you own bond funds, who's ever managing it is a good manager. But stuff that you never thought about before, this may happen. You hear CDC, Fauci, the other fellow that went out in front of the House of Representatives today, This may be a tough winter. You may have flu on top of this. So just because I have a few clients in Florida, and I was speaking to a couple of them today, they opened up Florida. So far, 2 out of the 3 of them told me nobody's going anywhere, okay? So if the people that are being governed by the laws don't obey, or one way or another, whether it's Wisconsin running to the bars or Florida not going, it's a whole separate story. You won't have any follow through. So take a look at that. I think we talked about it last month or 2 weeks ago, whenever we spoke. Take a look at some junk that you have and upgrade your portfolio. Okay, now's a good time to do it. There's stuff that isn't coming back. So stop making believe to yourself that it is going to come back. Energy, the weak sisters in energy, they're not coming back. They're going to be going chapter 11 or 7, depending on which, all right? That's number 1. Number 2, retail. Take a strong look at retail. If you want to be in retail, go into the supermarket business for the time being, okay? Retail business, not good, all right? All the Amazons of the world, including Amazon, are eating them for lunch, and the virus is just helping that situation, all right? Hotels, I don't think you want to be there. Again, if you can have risk tolerance and you want to find Marriott at the bottom, they'll survive, but it may take a while. I'll go back to energy. Had a client that bought Chevron 7 weeks ago. Guy made 35% on his money, but you have to be that kind of investor, a deep value investor, and then set yourself a goal and know when to get out. It's not the kind of situation that you hold forever, okay? This is now a completely different market than we've had over the last 3 or 4 years, whenever we've been doing these meetings. This is changing. If you want to stay where you are and you don't want to move or you don't want to pay for the trade, then just know you're taking the risk of doing nothing, okay? And that is a definite risk here in this market. So take your time, take a look at what you've got, take a look at what your goals are. If you don't care, then fine, but I'm assuming you wouldn't be on this call if you didn't care, okay? And judge, again, take a look at your goals. Is it to leave it to your children or grandchildren? All right. If not, you need a check to come in with Social Security and the pension, well, then that's another whole story. So each of you may have a different, a different outlook, okay? Molly, you want to open it up, or you got anything else that you want to say?
No, I was going to say that, where you should start is looking at your investment portfolio and look at it in the way that you say, okay, how much money do I have in equities, in stocks? How much money do I have in bonds? And how much money do I have in cash? That's where you have to start. And based on goals, you could have more or less equities. You probably need somebody to sort of help you to come up with what's the allocation for your situation. Once you've looked at what your asset allocation is, then you want to look to see how you invested, let's say, in the equities. Are you diversified enough? I looked at a portfolio today that somebody sent us in. It's all mutual funds, but they're all the same kind of mutual funds. Well, that's not diversification. I believe you should have some stocks for growth, some stocks for income, and some stocks that are value stocks. And maybe if you want to be a little less risky, have a little bit less value stocks than you would have growth stocks. But try to understand how you're investing your money, and if it meets your goals. And then, how are you going to manage this portfolio? In other words, if your equities go from, let's say, 50% to 60, and you should have 50, then, you have to take some profits along the way. And that's hard to do sometimes, to take profits.
We always say the retail investor is the worst in going and when to sell. So if you go ahead and you do buy, whether it's value or you're going to buy some momentum here, then set yourself a goal when you're going to get out, okay? If not, you never sell, okay? So that's one. The second thing is that get yourself ready that if it's $1 million portfolio or 500,000, whatever, know that you have a possibility of heading down yet from here 10 to 20%. Try not to listen to all the political yada yada that's going on. All right. Even though the markets say bounce today because they're going to consider now part of the Democratic bill that's going to add another $2 to $3 trillion into the situation. But look at the companies. The other thing to do, and again, you may need some help with this. This is going to be tougher. You want to look at the company's balance sheets. Okay, only the strong survive are going to be here. And if you're going to make believe that this is going to go away like the flu, you're going to be very disappointed. So for those of you that, may be Republicans or so, try not to listen to the administration when you're investing, because you can see that so far they're not batting well. And for your investments, you want to protect them. So if anything, you want to be realistic to slightly negative here so that you can bolster yourself up when it goes down, okay? So I think that's the way you need to proceed here. This is worse than anybody expected. And as many of them on TV say, listen to the science. I think at the rate we're going right now, by the end of the year, we're going to lose 250,000 people in the United States alone to this. We're tracking at about 1,500 to 2,000 deaths a day. And that may continue on for a while. And we don't even think we know all of them because people died and they didn't know what they died from, from there. So, this is serious stuff. And a little bit by living in this community, I always say, I say to Morley, it's like we live in Disney World here. It's not the real world. I do understand why people are straining at the bit to go to work because they don't have any money in the bank. So they wouldn't be on this call because there's nothing to manage. So you realize how many people in the United States live from week to week, month to month, whatever the case may be. And those are the people that want to open up, and I do understand that. Those of us a little more fortunate here, good for us for the time being. But all I'm saying is that if you're going to be in the market and you're worried about the next 6, 12, 18 months, then, batten down the hatches, and you got to be a little smarter than you've been before. That's it.
Mike, why don't we open up to some questions?
Sure, why not?
Okay, I'll unmute everyone.
Okay.
Everyone should be unmuted. If you're muted, it's on your end.
It keeps on saying Harriet's iPad.
Yeah, Harriet, you got.
All right, we'll fix that.
All right. So we either got rid of her iPad or Harriet. Yeah.
What about living on
Harriet has her iPhone.
Okay.
Are there any questions?
What about dividend stocks like AT&T?
What about them?
Well, they pay a hefty dividend, and you could live off the income, right?
Okay. So, again, you want to look at the balance sheets, okay? AT&T is paying a disproportionately high dividend compared to Verizon. Verizon has a much stronger balance sheet. AT&T may be at risk by the end of the year or the beginning of next year of reducing the dividend. The risk there is that they went into a huge amount of debt in taking on Time Warner, HBO, so on and so forth, and the market is reflecting that risk. That's why you're seeing the dividend. Again, they may pull through, just know what the risk is.
What about defense stocks like Raytheon?
Yeah, what about it? I mean, if it's trading in a trading range and you're watching it for a while and you think that it's starting to move one way or another, take a look at that. Again, if you're going to pick individual stocks, you got to do your homework, okay? And doing your homework, it depends what you need. If you need from the dividend point of view, Molly will tell you, you don't want to buy stocks just for dividends. There's a lot of risk. Stocks, common stock is the lowest on the debt scale, okay? So the dividend can go first. They can go Chapter 11 versus, say, when you want to buy bonds or mortgages or anything else on fixed income, they're higher up the debt ladder. We usually buy stocks for two reasons. One, growth, and then two, total return, dividends plus growth. So take a look at that from that point of view.
It's hard to just say, buy this stock, buy that stock. It depends how you want your portfolio to look. You don't start out with a bunch of stocks, buy this stock, that stock. I tell a story. Let's say you wanted to decorate a room. So you go to the furniture store, you pick out a nice looking couch, a table, a chair, a lamp, pictures and everything. You bring it all home, you put it in and say, I don't know how this looks. If you want to do it the right way, you get a decorator, you tell her, I want this room to look like a Florida sunroom. I want it to look like a cabin, whatever. They will go and pick out the pieces and put them together so that you get what you're looking for. So, we use the same approach in portfolios. You start out with what are you trying to accomplish and how much equity, fixed income, and cash should you have for those goals. And then diversify within each of those different asset classes.
It's exactly, you want to know what you're using your portfolio for. If it's just income, then we ought to focus on income. If it's partially total return, then you want to take a look at that too.
Like Mike said before, it used to be many years ago that bonds always had a better income stream than stocks. Today, that's the opposite. The stocks have the income stream, the bonds have very little in terms of income. I mean, you buy, and bonds have risk to them, not risk that they'll default, but you buy, let's say, a 10-year treasury, and you're getting, what is it, got 70 basis points on a 10-year treasury?
Yeah.
That's 0.7%. If interest rates should go up, the price of that bond would come down. And you'd have to, if you wanted to sell it, you'd have to take a loss or wait for the 10 years to get your principal back. I think there's more risk that interest rates will go up than go down.
You're going to have,
they're going up, but they're certainly
we said
not
that
gonna go
before,
down
you're
a
going to
lot.
have unintended, you're going to have unintended consequences by all this fiscal stimulation. May not happen this year because you're absorbing it, but by throwing all this money at the situation, sooner or later, there'll be a change in the fixed income. The market will even pull up the Federal Reserve. Right now, you're going in the right direction, and you have a crisis right now. So that's for sure.
Do you see a scenario for a total disaster?
I'm sorry?
Do you see a scenario where we'll have a total disaster, like 70% down, I don't know, 80% down?
Well, then you shouldn't be, like Molly says, then if you believe that, then get out of the market.
No, if you see such a scenario.
Oh, do we see that scenario? I'm not smart enough to know that. I don't know. You'll probably see better by the end of the year. You'll have a clearer vision of where this is going. Needless to say, if we have a vaccine in 21, that'll modify the situation until people will know that the vaccine works, and then you feel comfortable. But I mean, I just, for the time being, I don't see how just take recreation alone in the United States. How are people going to go to ball games or cruises or almost anything that has a crowd? I mean, we're happy when we have 60,000 people in the stadium and so on and so forth. I don't know if that's going to happen. We're going to have to see if that's so, and not judge by the crowd that we have here by taking a good cross-section of how many people. This goes back to the old story when Molly and I started with this, risk and reward. Is the reward going to see the Yankees win good enough for the risk that we all may get sick and maybe some of us will die? That's risk and reward.
So I was mostly cruising on S&P, not much than that. But now you also said that we need to be more precise, surgically deciding what you want to do, because S&P probably won't do as well.
Well, let me answer that. There's other indexes.
It's too wide. It's too wide.
there's other indexes that you can buy. You can buy the SPY, which is the S&P 500. You could buy the NASDAQ, which is the QQQs. There's also a mid-cap index. These are stocks that are not as big as the large-cap stocks. There's the Russell 2000, which is 2,000 stocks out of 3 that are smaller. So there's other indexes you can buy. And I would say if you're going to go into use indexes, maybe diversify your indexes a little bit. Because there are times when the S&P will not do as well as the rest of the market. Now, it's been a long time that the S&P has done better than the regular market, the general market. But that's because you've got Amazon, Microsoft, Netflix, about half a dozen stocks make up about half the return of the index. Anybody that tells you how the thing is going to unfold, they don't know. So you either have to have faith or, sometimes you have no choice. If you can't live off of 0.5% a year on your portfolio, you've got to step up and take a little bit more risk to get those returns up.
What if you have a Democratic in the White House and in the Senate and House? How would that affect your stocks?
You're going to probably have more taxes. You're going to be taxed more to do that. And depending on how this goes, you'll see whether they're going to, I'm not sure that you're going to have that, but you're going to, maybe more government spending on top of that. Hard to know yet. We've got to see how the second half of this year starts to play out.
Can I ask a question, Michael?
Yeah.
You didn't mention healthcare stocks or companies.
Right.
Well, I think I think Molly and I talked about, look, the 2 areas that are going to be strengths for the rest of the year are going to be some of the FANG stocks that Molly mentioned, technology, because we're all working more remotely than ever before. And that's good reason to like Verizon and somewhat AT&T also, because they're the deliverers, they're the major deliverers of that. And take a look what Cisco just reported. Their business is starting to pick up. Intel looks pretty good if you can buy it in the mid-50s or so. And they have a dividend. So take a look at some of the older tech companies that either acquired or reinvented themselves a little bit. They may be good for 6 or 12 months. And again, if your theory has been long-term investing and buy and hold, that may not work as well over the next 6 to 18 months because of the situation we said, okay? And again, take a look, and each of you are different, so this is tough to do. Take a look how much of that portfolio that you're watching and looking at, how much do you have to pull out of that every month for whatever you may need it for, okay? Children, grandchildren, yourself. Because that's going to be the real challenge as we get to the end of this year and next year. Because Molly pointed out, interest rates, I never thought in my lifetime I would hear about negative interest rates in the United States. I don't think it's going to be there. It didn't work in Europe. It didn't work in Japan for the last 20 years. But there's some conversation about it right now. So let's just say that if you bought yourself a CD to the end of the year, like I just bought for somebody for $50,000 or whatever it was, I got him, the best I could get him is 0.45, okay?
Yeah.
So, you go up from there, you have to go up the ladder. And maybe you want to look at an ETF on high yield debt that may work for you. There you're in the 4 to 5% rate, all right? But then you can get that somewhat between Verizon and AT&T. To Len's question, it looks like the pharmaceutical area for a couple of reasons. I think we mentioned this last time. One, Congress is going to definitely be off the pharmaceuticals back about overcharging. That's a big plus for big pharma. And if you're not in pharma now, you can buy one of the Vanguard funds that aren't bad. I think it's a VHT. That'll give you at least a mix there. If you buy the big pharma, at least you got a dividend there between Merck, Pfizer, and Bristol Myers. 3 different, okay?
And Pfizer and Gilead.
Yeah, but Gilead's a different story. That's a whole separate story. There you want to be. Now you're talking more biopharma, and you're not talking about the same. You're talking about a little more risk there. With remdesivir, I think that looks like a decent drug, certainly again for the next year. The big pharma stories will give you, again, depending on the kind of investor you are. If you're a conservative investor, will give you a nice sized dividend and probably steady growth. Take a look at CVS, not the drugstores. They're going to be doing a lot of this testing, and they're going to, I think we said this before too, they're going to be vertical within the next year. So not only do they have an insurance company and nurses and now doctors going in there, they're going to give you the medication. So they're going to take you all the way through from beginning to end. I think that's going to be what the new pharmacy is going to look like. So those are some ideas. Certainly, them and the technology area certainly look like they'll hold their own for the next 6 to 8 months. And again, it depends how bad this gets. It's possible that we haven't seen the worst of this yet.
Michael, I have one question. Could you clarify for me what negative or how negative interest works? I'm not quite clear.
Yeah, you're going to pay somebody to take your money. Okay.
Okay.
So, okay, and what happens there is that's a cost of doing business for corporations. That's what happened in Europe, and it happened in Japan. Okay, but if you're running a 20, 30, 40 billion dollar portfolio, it's sort of set out for you by the chief investment officer how that money is set up in their investment group. And a certain amount of that should be in the banks, insurance companies, bonds, et cetera, et cetera. And that's the way it's set, okay? So they have to put the money there. So actually, you put $10,000 down, you get $9,900 back.
I see. Okay.
FDIC insured here, okay? I don't believe that'll happen here, but, like I say, who knows? I don't think it'll happen here. You're down to zero. There's no place to go.
I just want to inform everybody that I've been recording this meeting. And when I did the other night, created a channel on YouTube. It's called Stonebridge Investment Discussion Club. And I plan later tonight to upload this meeting after we're done to the YouTube site. If you have any issues getting there, you just do a search on YouTube for Stonebridge Investment Discussion Club, and you should get to the channel. I created a channel. And if you have any issues, you can email me and I'll try and be helpful. Are there any
no need
other
for password? No need for password. It's open. It's public. No need for password.
Yeah, I created it as a public channel. Correct. Yes.
Len, I have a question.
Do you have
for
a
people?
Oh, wait. I think who's speaking? Steve?
No.
Who had a question? Someone had a question.
I did, Marianne. It's Marianne.
People here have an idea how their investment portfolio performed over the last couple of years?
Yeah.
Other than it went up or went down, but
it was okay till February.
What's that?
There's your answer, Molly. Yeah.
You should know how your portfolio is doing, because if you set it up with goals and you set the portfolio up to meet those goals, then you've got to monitor it to see, is it doing what you expect it to do? If I ask the question, what are your expectations for, let's say, the next 5 years for the stock market? What kind of percentage return do you think is reasonable? There's no right answer to this, but here, Harriet, how about you? You asked a lot of questions.
Not yet.
12% return, 4% return. You've got to really have some idea of what kind of returns you're shooting for, and then monitor those returns to see if you're getting them.
And again, it's going to be different from each one of you depending what your mission is for the portfolio, okay? If the mission is, again, some income to take out, that's different than a guy says, oh, I got a few $100,000 in the market. I don't care. It is what it is. So that depends on what you do. But you should match your portfolio against the major averages just to see how you do. I think we're boring someone to death. He's yawning. Who is that? Marvin?
Aren't some of these growth stocks speculative?
What's that?
Aren't some of these growth stocks speculative?
The whole market could be speculative right now.
Depends how you define speculative.
Yeah.
Right. Everything has risk. And sitting with cash in a money market account on 100% of your portfolio, that's a risk because there's risks that you will not achieve your goals.
And the risk is that, again, if you need some of that money and inflation does set in, well, you're not set to take on some of that inflation risk. It's not here today, but it may be in 21 or 22.
Yeah, I have a question.
Yeah.
For Morley. Knowing that the market is usually ahead of economic news, the way you mentioned before, 1 to 2 months, if the country starts opening up over the next few months, over the course of the second half of this year, when do you think that the market is really going to start turning upwards again? I know it's a guess. It's anybody's guess. But considering the country start opening up, when do you think the market's going to turn?
Yeah, hi, Art. I didn't recognize you at first, but I see you now.
Hi, Marley. So I come next door and talk to you?
Marley, he's good. He's a good friend of my partner. Yeah. So.
Oh, okay. If the economy is going to start to pick up at the second half of this year, the market will be responding right now. The way it works is that the market collectively is smarter than any individual. So, you know, if something is doing, let's take a stock that's, or an industry that's doing lousy. Well, some people will start to see it looking bad. Not a lot, but some. And then that'll turn the trend of that stock, of the market, upwards. And then as more and more people see it, it keeps driving it up and up until it gets so expensive. Value advisors start to sell it and have it come down. You know, so the market responds, you know, usually 6 months in advance of the economy.
The real answer is, the real answer is we really don't know. Yeah.
Say that again, Michael. I missed that.
I said the real answer is we really don't know, and I think we're going to have to wait for this winter to see if this virus we're dealing with, laid on top of the flu, is really something that we're going to have to deal all over again with. That is a wild card situation right now. I can tell you this, that we're not going to see 3.5% unemployment again. If you take that this economy, the U.S. economy I'm only talking about, is 70% consumer driven, okay? And we have some of these health concerns laid on, you're going to have a whole different situation than you're used to in 17, 18, and 19, okay? No matter what. People are just not going to, the consumer is not going to be there to drive the economy. So you want to play it safe. Again, goes back, how much risk are you willing to take for whatever reward that you're looking for?
And you can calculate what the potential downside is. And you'll be right, you know, probably 80, what's that, the bell curve, 2/3 of the time you'll be right.
Yep.
1/3 of the time you won't be right. But, you know,
and again,
one thing that's a positive is that you've got 70 different medical groups all over the world working on this virus. So, you know, if you've got all of these brains trying to solve one problem, there's a good chance they're going to solve it within a reasonable amount of time. So, you know, that's the one positive thing about this.
It's up to each of you to know how far you're willing to have the portfolio go to before you start waking up at 2:30 in the morning, okay? That's what you have to determine, okay? And once you determine that, then you kind of know what your risk is.
Michael, okay, you have a question, Michael?
Which Michael?
Eisner?
No question.
Okay, well, the comment on the vaccine, from what I understand, this is a different type of vaccine that they're preparing, unlike the others where they have live virus or a dead virus in the vaccine. This is an RNA virus, and they've not prepared a virus against the coronavirus, from what I understand. That's not to say they won't do it, as Michael Bauer said. It's just that this is still uncharted territory, so to speak.
Look, once you even have the vaccine, you got to say we got to make 300 million before many of the people are going to be comfortable, right? Because the other people that didn't get it, which are the anti-vaxxers, you're going to be worried about that you're going to be exposed to them. So in my opinion, you're well into 21, okay? So if you're buying or selling, make sure that you have all of these things that we're talking about in mind. And if you don't feel right, then either pull to the sidelines, get some help, you know, if you think you need help for that, because the environment over the next 12 to 18 months, I think is going to be very different.
Yeah.
One of the ways
okay, go ahead, Morley.
One of the ways to measure risk in your portfolio is you say, all right, let's assume you've got 50% stocks and 50% bonds and a little bit of cash as part of that 50%. Well, if the market were to drop 20% and your stocks drop 20%, because it's only 50% of your portfolio, that would mean a 10% decline. If bonds made 0, then your portfolio dropped 10%. So if you say I can take a 10% drop, then 50-50 is not a bad mix from a risk point of view. Now the market might go down more than 50% than 20%, but 2/3 of the time a 20% drop from where you buy it is probably a good way to gauge it.
Can I ask a question?
Sure.
What do you think about commodities like gold, which is generally tended to be a hedge against drops in the market? Do you think that makes sense to consider, or is it just that even too risky?
We don't do that. It doesn't earn anything, and you're late to the party. Okay, if you bought gold at 1,200, you find 1,100, whatever it was. And for trading portfolios, it may make some sense. Hedge funds, my guess is in your portfolio, it doesn't make any sense at all and doesn't earn anything. You want to buy it when it's cheap and hold it for diversification, fine. But you're late to the party on gold this time around.
I agree with Michael that you buy gold because you expect somebody else to pay more for it down the road.
Right.
It pays no income, no return. So it's just an old European thing that's been carried on. Europeans, when their governments would fail, the currency was no good anymore. So they would turn their currency into gold to try to preserve it. And I think, that's the mentality of things. I know people say, look, inflation, people buy gold. But gold's been as low as, I remember it started out at $35, but it was basically $800 an ounce, right. Went up to $2,000 an ounce. Now it's back to what, $1,300?
Somewhere in there. I mean, unless you can give a good reason for your portfolio.
I'd say put a 2 or 3% position in your portfolio, but no more.
Okay, there's another, aside from all the questions, everything, if people have more questions, fine. At some future date, if you want, the investment club had purchased a couple of CDs on investing, but I have a subscription also to the Great Courses Plus, and they have some finance videos on there that are a half hour each. And at some point, if there's an interest, I can play it over the Zoom meeting by sharing my screen. Is there any interest in that?
Yeah.
Okay. Well, if there's any interest, you can email me and I'll proceed with that. But are there any more questions?
Yeah, Lanny, you going to deliver the refreshments?
Yeah, they're virtual though, however.
Good point.
It's called self-service. Yeah. Okay, so here's the story. As I said earlier, I'm recording the meeting, and when it ends, tonight I'll post it. I'll upload it to the Stonebridge Investment Discussion Club channel on YouTube, so you can watch it again. Jerry Morelli actually asked me to record it, so that's why I did what I'm talking about now.
Yeah,
I got a question for Mike.
Before you sign off.
Yeah.
Yeah, Mike, listen, we know that the shopping experience is going to change drastically.
Right.
People are going to fear going to stores for quite some time anyway. And we know that the malls are going to pretty much be dead. But
I think they're going to just change. There'll be malls, but they won't look the same.
Correct. And consumer spending, pent-up consumer spending has got to be spent somewhere. It's most likely online for the most part. So
Right.
I see that whole arena changing and being developed more so than it is now.
Mm-hmm. Agreed. So the winners there in the discount areas, Walmart, then above that is Target. Maybe Macy's will survive as the only department store left. Nordstrom's is tightening up. You saw that they're closing 16 full-line stores from there, and I assume most of you read Lord & Taylor is going to be liquidating and going out of business before the end of the year. So here you have your first casualties/fatalities from there. We think that the malls are probably going to turn into, could be doctors, dentist's office, lawyers. There may be some that become entertainment. Again, crowds are always a problem. I think watch the one up by MetLife Stadium and see how that goes in this new environment. I could see that as becoming, if we get on top of this virus, but I don't think you see anything until 22. So, it's tough to talk about long-term investing in this community, There's nothing much long-term. So, you got to talk intermediate to short-term. I mean, realistically, when they tell you on CNBC, oh, you're in there for 10 to 20 years. Oh, great. Okay. So yeah, but I think that's where that mall business is going. And if you look at the next generation in your families, I look at it in mine and watch the daughter-in-laws, and I have already 2 teenagers as grandchildren. Nobody goes and hangs out in the mall anymore. Okay, and that used to be a big favorite, 10, 20, 30 years ago. So there's definitely a change. What this virus did was speed up the trends that were happening, okay? Lord & Taylor probably would have made it another year or two. Nordstrom's is closing. One of the 8 stores that Nordstrom's is closing is right here in Freehold Raceway Mall because the landlord there it's a tough deal. So they just decided to close down. But that's what you're getting. You're getting a speed up of the trend. And Walmart and Target are making their money by delivering it to you same day, next day, whatever. No delivery costs for the time being. So that's where you're at. I think you may get some good value if you move over into the food business and watch companies like Procter & Gamble, P&G. If we're going to stay home for the next couple of years, that's their strength, okay? And that kind of thing. It's hard to know because I don't know if anybody tells me how long we're going to be under siege. It'll be much easier to estimate what's going on. But that could be a possibility. J&J also looks good on the consumer and that. But you got high prices. You're not the first one to run into that. But if the market pulls back 10 or 20%, that's when you want to go ahead. When you feel bad, that's when you want to go ahead and buy. The retail investor is not good in doing that. Okay.
Yeah, Mike. entertaining world, you know, all the concerts, the singers, all of that stuff, that's also going to be throttled back. So they're going to have
Live Nation. I have a client that works with Live Nation. Yeah.
Well, they're going to move to HBO, and they're going to be putting concerts on in that arena.
Exactly.
So that's going to be another thing, you know, the commercial or the ads that they're going to sell. HBO and on demand and all of that kind of stuff is going to be huge.
Yeah, well, that's why Netflix is going through the roof right now.
Right.
I think you can make a case that if Disney can get itself up in the theme parks to 60, 70% eventually, that Disney Plus, they really know how to do entertainment. Nobody markets better than Disney. And you got Disney trading between 100 and 105. You may be looking at a decent buy there. Okay. But you have to have patience in this market. This is not going to happen overnight. You're certainly right about that. There are definitely different lifestyles. And again, if you're saying that we're going to be consumer driven in the 2020s, then just think of the changes that the consumer is going to be doing at least for the next couple of years.
Yeah, I think you just said it before that the crisis accelerates all of that. It always has.
The trend was there. Yep. And you're definitely right about that. The trends were there, but they're gradual, so you can live with it. Now it's like you just got smacked in the mouth and you didn't know where the hit came from. I'd also, as you're going through your portfolios, clean up for the time being, clean up REITs. You know what that is? Real estate investment trusts. They're gonna get whacked. Okay. Commercial real estate for the next 12, 18, 24 months. Bad. Okay. Bad. If you can hang in and it doesn't make any difference, fine. But some of these guys are really going to take it on the chin. The people, wherever they are, the companies are going to walk away from the situation or renegotiate their leases down significantly. Okay. Big challenge, especially in the metro areas, starting with New York City. That's going to be a big risk.
Michael, I heard a sort of a counter argument to what you're posing, in that companies, especially large companies, will want more office space, and that might be good. And in addition,
I heard that argument too. I don't believe it.
Oh, okay.
My company employs 58,000 people. Okay, I'm telling you, they're negotiating their leases down already. Okay. The amount of business that can be done remotely, okay, is going to dwarf whatever they're talking about, that because we have to stay 6 feet apart, we're going to need more space, okay? Many major corporations say, you know what? If we can't have collaboration in the office, what's the purpose of the office? Now, that doesn't mean by 2022, we may be moving in that area. Again, depends on your timeline. But if you're going to look at the portfolio every month, oh my God, it's going down again, then you're talking about a different story. It just depends on what kind of an investor you are, okay? If you don't, then you just buy it and put it away, great. And don't look at it for the next year. But if you're going to look at it every day because you have nothing else to do, then you're going to aggravate yourself.
I'm already aggravated.
I had a client today that liquidated the entire portfolio, $800,000. He wanted to go to cash, couldn't take it anymore. Okay, so that's what happens. And he could afford it, but you just can't take it anymore. He made some gains, he made some losses, whatever. Couldn't take, and the guy is in his mid-60s. Okay, it's not like he's 88. All right, so we're all different. And we're all react different ways. And Morley started this off. If you can't take the heat, then get out of the kitchen. All right. But I think it's going to be a little rocky for a way to go.
So, Michael, with going back to what you just said, with your client that just went 100% to cash,
yeah,
what are you advising him to do? Sit on that until 2021?
Well, we moved him away from it that at least he stayed with 100,000 in certain equity, but we had to explain it to him. That's how the morning started off. Welcome to my mornings, But he says, and I think he will, he'll get back in 6 and 9 months. He was waking up at 2:30 in the morning in a cold sweat. That's who it is, It's like people reacting differently to the virus. We're going to react to this kind of situation, and you get so much information. I mean, my God, you could watch television or listen to the radio or whatever, or online, streaming. You could watch this 24 hours a day and drive yourself nuts.
Did he sell before the market turned?
I'm sorry? Well, I stretched it out over the day, so at least he got a better deal. He wanted to dump everything in the first 10 minutes of the day. Okay. And I've been a client for years. Okay. It's caught me by surprise, to say the least, but that's what happens here. And sometimes things happen at home. His mother-in-law was this, and this one got sick. And so, it's hard to know. Everybody's got personal stories on top of that. So, if you're all prepared, then put your seatbelt on and get ready for a little rocking and rolling for the next 18 months or so. I think we're going to see some ups and downs before we get to the other side.
Okay.
And I hope I'm proven wrong. I don't think so. No.
But if we get some feedback, if people would give us, what are their takeaways from this meeting? Anything?
Well, the takeaway, Morley, the takeaway I get is we're in uncertain times, uncharted times, uncharted what normal 2.0 is going to look like. And it's a little bit unnerving. I mean, I'm just ready to throw my hands up, in terms of how you.
Well, there you go. The closest health crisis we've had in that is that 1918 Spanish flu, but the world is just so different. I'm going to stop there. I mean, they thought that 20 million people lost their lives in that. Okay, that's the closest. And I'm sure many of you remember polio, but that was more gradual. And maybe we'll learn to live with this. You're going to have to see whether society accepts a certain amount of death rate. Until we're treating it better in the hospital now. So we learn some things like that lady mentioned, Gilead. Great, I think that's worthwhile. And maybe we'll, and maybe we won't. You'll know yourself. You'll have to, at one meeting, tell me whether you went to a restaurant and you sat next to anybody, or anybody went to a Giants football game, or, look at those, type of situations.
Well,
okay?
As far as restaurants, I have a friend in this community who said he won't go to a restaurant for 6 months.
Yeah, and again, I try not to extrapolate this community onto the rest of the state.
Yeah, okay.
Because
the disturbing thing for me is, unlike 911,
right?
We're so divided in our opinions and outlook on worldview that that's a little unsettling to me.
Len, I think.
Well, it is, but the major thing, besides putting politics aside here a minute, is really your survival. Are you willing to risk really getting sick? And there's a good chance every one of us on this screen won't make it through because of age and underlying, other problems. Won't make it through if you get sick. So I ask each one of you, at what point are you willing to risk and step out and go to a restaurant or go to a lecture or stuff like that? I don't know. Did anyone think about that when you're ready to do that?
Well, the other.
I'll
anybody have an opinion?
Yeah, I have an opinion on that. I think the biggest thing is, especially for people in our age group, we know that the death rate in upper age groups are much higher than anything else. But what we're not seeing is a statistic saying how many older people get corona and survive. We're not seeing a number on that one. So until we see a number on that one, it's hard, you're missing some data and you just don't know.
Exactly. And I'm not sure, again, when you see the data, it'll be interesting how it affects your behavior, because that's what we really have to take a look at. The two people I spoke to in Florida, they've opened up Florida and they closed it real late. they were telling me that the malls are empty even though they're open. You know, the ladies are going to get their hair done and so on and so forth. You know, that's a must, okay? But, you know, aside from that, you may not wish to take that optional part of going to get a steak or a piece of fish, and you'd rather have it delivered because you just feel it's safer. Or do it yourself because you know what ingredients go in.
The senior communities in Florida that are similar to ours are.
One at a time, yeah.
I would say the senior communities in Florida that are similar to us are not reopening. They're staying just as closed as Stonebridge is, because I live in one of those as well. And nothing is changing in the senior communities.
Right.
Yeah, I have a friend coming up. Matter of fact, he's coming home now from Florida. Their pool, 2 out of their 5 pools are open. They're, you know, social distancing, but they opened up like 2 weeks ago in this community.
Right.
I think that's in both.
Right. Yeah. I think we're going to have to see how, you know, I look at the senior communities as key in travel. Okay. I think probably over the age of 60, I'm guessing when I say this, 75% of the cruise business. Anybody going on a cruise in the next 6 months? I don't know. Okay. I don't think so, but maybe. So those are the kind of things. How about flying? I have clients that are making up their mind. They may not come up from Florida this year because they can't decide whether to drive or fly, that risk. So maybe we'll just stay there and bear the heat of the summer in Florida. Okay. Can't see the family because the family won't let them come there because they're afraid the kids will give them something. Okay. So a lot of change behavior here. That's going on. That's why I say sometimes when you're thinking about this, especially on investing, you got to think outside the box of Stonebridge or Boca, or, you know, where we're talking about. And that's not easy, okay? Because then you got, you know, I think baby boomers pretty much make up about 20% of the United States population. So 330 million people. So maybe about 50 to 60 million are in that 55 to 85 range, okay? Yeah. So those are the kind of things that you got to think about. What are the other, you know, what are the other 80% of people doing?
Yeah, one thing, Michael, that has come up in the last couple of weeks because of some reports that the children, you know, kids from, I don't know, infant to 21, let's say, people like that are having complications with that anti-inflammatory.
Yeah, I saw that.
And so this poses a problem as to what this, if I were on a school board, what would I do knowing that? And if I were a parent having young children, how would I feel sending my kids to elementary school? You know, it may be coming.
So Len, the position you hold in Monroe Township, what is Monroe Township planning for the schools for the fall?
I have no idea. I'm not on the school board. I'm only on the township.
No, but I thought maybe.
Yeah, okay. But aside from that, it's a little unnerving. I mean, I work as a substitute in the Monroe Township High School.
Right.
And, I haven't been working, but in the fall, I am not sure I want to do it, even if they open the school.
My guess is that from the school situation, and it's a little tougher at college, but up to K to 12, I think you're going to probably see a lot of school systems going to split session. I grew up in New York City, and a huge explosion of population, especially where I lived in Queens. And I checked with my brother, who's younger than I am, and they went at one point at triple session because they couldn't handle the amount of people that baby boomers were being born and so on and so forth and going on. They went from double session to triple session on the schools. I think that may happen here to accommodate keeping the kids far enough apart. But good luck trying to keep 4th grade boys from jumping on top of each other, 10 times a day. So,
anyone who's been in the high school or the middle school in Monroe, between classes, it's there's no way they're going to have 6-foot separation.
Absolutely. I agree with you 100%. That's going to be, there's a certain risk there. and we're going to have to see if they're willing to take it. So that'll be interesting to see. But yeah, there's going to be, there's a huge amount of changes between now and 2022 for the time being. So, adjust your portfolios appropriately, is what I'm saying.
Okay, Michael Morley, I appreciate, and everyone else who participated, I appreciate it. It's now 8:09.
Okay, great.
And I thought that unless there's someone have a pressing question, we don't want to discuss politics. That gets us into trouble. But
agreed.
We just did, but to some extent. But in any case, you could check out the recording if you missed something and you want to hear it again. I'll post it later tonight.
Thank you.
All right, good night, everybody. Stay safe and stay healthy.
Thank you very much.
Thank you very much.
Thanks for coming.
Thank you.
Good night.
Okay,
Thank you.
bye now.
I just finished my meeting here.